Hey, what's going on YouTube? And welcome back to Tech Conversations. Firstly, if you haven't already, make sure to check out Lux Algo. Lux Algo has some of the best trading indicators and AI agent for backtesting used by over 15,000 traders, including myself. And I've covered many of their premium indicators in the past on this channel. So right now, if you sign up to Lux Algo by using my link in the description below, you can get up to 35% off. Keep in mind you can get 30 days risk-free, so why not try it out? So go ahead and check out Lux Algo. I'll put a link to them in the description below. Also, make sure to check out the Discord, completely free to join. I'll put a link to it in the description below. We're almost at 8,000 members now, so thanks everyone. Now let's get right into today's video. So today, I want to talk about an interesting topic that I see all the time: risk-free option strategies on Robinhood. So for today's video, we'll actually be taking a look at a put credit spread. And I'm going to be using this stock right here for today's video, Penn Entertainment. Ticker symbol PENN to show you the examples. Again, everything I'm showing you here today is just that, examples. Now, let's go ahead and let's get into this. So, remember, a put credit spread is a bullish strategy. That means we generally want the price of the stock to go up. So let's say we're bullish on Penn Entertainment. So let's go into the options here for PENN. So let's go over to the option. Let's click on this button here. So this will take us to the options for this security. And as you can see, we're currently looking at calls here. So the first thing I'm going to do is I'm going to select an expiration date here. And so where do we do that? We come up here to the top, and there is this section where you can select your expiration date. So again, let's say we're bullish on this stock, and we want to give it enough time to go up in price. So let's go out almost 1 month. So let's go out to, let's say, September 5th or 26 days away. And let's select that as our expiration date here today. Again, we want to give it enough time to go up in price. Now, as the name suggests, put credit spread is going to involve puts. Right now we're looking at calls here. So I'm going to switch over to puts here. And here is how you set up a put credit spread. So the first thing we do here is we would determine what price we believe the stock will be above at expiration. And so again, my expiration date is September 5th. I want to give it enough time to go up in price. So let's say, and again, I'm just making this number up, but let's say that at expiration, I believe this stock, PENN, will be above $19. Right now, it's currently almost at $17. So let's say by expiration or at expiration, I think it'll be above $19 a share. So the first thing we would do then is we would start by selling a put there. So I would switch up here to sell, and then I would look for a strike price of 19. And we take a look, there is a strike price of 19 right here. So I would start by selling this put right here. Next, we also need to buy a put here, and we want to buy a put with a lower strike than the strike of the put that we're selling. So the strike of the put that we're selling is $19. So now I would switch over to buy here, and I want to buy a put that has a lower strike than that. So here's the strike, or the $19 strike. So I would need to buy a put below it here. So I'm just going to buy the put right below it at the $18.50 strike price here. So let's go ahead and select this here. And so as you can see, this is a put credit spread. Robinhood recognizes this as a put credit spread. As the name suggests, right, we're using puts, and we're also going to be entering for a credit. And we can see this down here. So how much is the credit according to Robinhood? It's going to be about $56 here. Now we can already see here something interesting going on. Where do we see that? We see that in the P&L chart here, right down here. Expected profit and loss, $6. Max profit, $56. And as you can see, there seems to be no max loss, no break even. And all we see is green here on this chart. Very interesting. Now, if I click continue here, since we're entering for a credit, that means we'd have to put up collateral. So if I review this order, you can see here, $50 in collateral. So according to Robinhood, for this put credit spread, we'd be entering for a $56 credit, and we'd have to put up $50 in collateral here. So let's go over to Option Strat. Let's visually take a look at what this trade looks like. So I'm going to go over to Option Strat. I'll put a link to Option Strat in the description below. Really great options visualization tool. So again, this lets us visualize a trade. So I'm going to go to build, and I'm just going to start with a put here. So again, the stock we're using for today's example is PENN, Penn Entertainment. The expiration date I selected is September 5th. And then again, first thing we did was we determined what price we believe the stock will be above at expiration. Again, I just said, let's just say it's going to be above 19. So we'd start by selling a put at that strike, so at the $19 strike. And then I said we also need to buy a put, and we need to buy a put with a lower strike. So I said let's just buy the put at the 1850 strike. So as you can see, Option Strat knows this is a bull put spread. That's just another name for put credit spread. And if we take a look here again, we're entering for a credit. So $56 here, according to Option Strat. That's the same thing Robinhood said, right? $56. Then we need to put up collateral. $50. Same thing that Robinhood told us. We're putting up $50 in collateral. Here's that $6 that we also saw over in Robinhood. But notice here it's saying min profit $6. Usually you will see a max loss here, but here it's saying min profit $6, indicating that at a minimum we're going to make a $6 profit. That's the worst thing that can happen. That's what this is saying here. And then we have our max profit, $56. And then take a look here. If you have the premium version of Option Strat, it'll tell you the chance of profit. It's telling me here that I have a 100% chance of profit, which makes sense because according to Option Strat and Robinhood, it's saying that my min profit is $6. And there's no break evens because I'm going to make money no matter what according to this and to what Robinhood is showing me. So did we just find a risk-free options strategy? A strategy where I'm guaranteed to make a profit. There doesn't seem to be a loss or any downside. Well, let's go back to Robinhood and let's try to place this trade. So a lot of people run into the situation here. And so let's see what happens if we try to place the trade then. So notice here, we're back on Robinhood, right? This is where we're going to place the trade. Well, here it's asking me a question. It's saying, are you expecting to receive a credit or pay a debit for this option? So again, this is a put credit spread, so we know we should be entering for a credit. So I'm going to go ahead and select credit here. So I selected a credit there. And then it's asking me about entering a limit price. So I'm just going to click continue here. And so let's go ahead and let's try to submit this. Let's see what happens here. So notice what just happened. Did it let me submit this trade? No, it did not. What does it say? It gives me an error. Order premium must be less than collateral. So Robinhood knows that the credit that I'm receiving needs to be less than the collateral I am putting up. Otherwise, it would be a risk-free option strategy. But the thing about that is it's not possible to enter a risk-free strategy here on Robinhood. And so then the question is, why do we see this in the first place then? Why do we see that it says, min profit $6, there's no max loss here? The problem here, and the reason we're seeing this, and we're seeing this here in option strat, so we see it in multiple different places. The problem here is the very wide bid-ask spread. So you can see the bid here, and you can see the ask here. It's a very wide spread. And this is due to low liquidity. If we take a look at both of these options that we're trying to trade here, they both have zero volume, zero open interest here. And so when you have low liquidity, you get these very wide bid-ask spreads, and then you run into situations like this. If we go back and we remove these and we do something that's, has a little bit more liquidity here. Let's say instead I sold the put at $17.50 and I buy the put at the $17 strike. Even though these still don't have very high liquidity, but they do have some volume, some open interest. Now we'll see the bid ask is a little bit more normal. And so now you're not going to see this thing where it shows you that there is no loss here. So the next time you see an options trade that shows no loss, right? It's showing you that there is a guarantee that you'll make a profit. You will know what's going on. So anyways, if you have any questions, feel free to leave them in the comment section below. Check out the Discord, link to that in the description below. Hope you enjoyed the video. Let me know what you guys think. I will see you guys next time.